Welcome to the Same Day Podcast, where we discuss driving incremental business growth and other topics related to real estate, property management, and entrepreneurship. Now to the show at hand.
Matt Zalk here. I'm the host of the Same Day Podcast, where I connect with top business experts and real estate leaders. Past guests include Devin Howland talking about economic development in Fayetteville, Arkansas. We also had Elliot Nelson on the show from McNally's Group discussing community development through restaurants and bars in Oklahoma City and Tulsa. Today's episode is brought to you by Keyrenter Property Management. At Keyrenter Property Management, we are a full-service property management company helping our clients buy, renovate, and operate real estate assets. We help our clients build wealth while taking the headache out of property management. Tom, you know how hard it is to line up contractors to get make-readies done in a reasonable amount of time after any occupant, whether it's a single-family resident or potentially even a self-storage client, moves out of a property. The work seems to drag on forever. Contractors are busy and hard to line up, and all that leads to lost rental income. At Keyrenter, we line up our dedicated vendors so that turns can happen super quickly and we get more money back into the pockets of our owners. And that is why no matter what rental you have, a single-family home, condo, townhome, apartment, we have the management solutions you need. Go to keyrenterpmc.com or email us at info@keyrenterpmc.com. Today's guest is Tom Dunkel, who brings over 28 years of real estate finance and investing experience to his position as Chief Investment Officer. Tom makes it his mission to find great investment opportunities for his clients while helping them meet their wealth-building goals. Since launching a full-time career as a real estate investor in 2006, Tom has raised over $65 million in private money across three asset classes: self-storage, short-term rentals, and distressed mortgage debt. Prior to investing in real estate, he worked in mergers and acquisitions, closing over $1.2 billion of deals in aerospace, IT services, software, and logistics. Tom lives in Wayne, Pennsylvania, enjoys golfing, hiking, and playing guitar. We want to hear him wail on the show today. Let's see if we can make that happen. As an avid investor and lifelong learner, Tom is actively involved in organizations including Self-Storage Mastermind, is a Raise Masters coach, and was recently named a Marquee Who's Who honored listee. Tom Dunkel, welcome to the show. How are you?
Hey, Matt. I'm great, buddy. It's great to be with you and all the listeners. I'm looking forward to our chat today.
So I want to start with your previous experience before we dive into your current experience doing M&A for a bunch of interesting industries. How did you get into that? And let's talk about your most exciting deal. That'd be a good place to start.
Oh, wow. Geez. Yeah. So how I got into it was, I got out of business school and I was, kind of a finance and accounting guy coming out of there. And so interestingly, I learned plenty. I had some great professors at William and Mary, but where I learned a lot was in an internship. I worked for one of the professors who was on the board of a local charity, and he said, "Hey, here are the financial statements. Tell me when we're going to run out of money." I'm like, what? So the project forced me to learn like the nuts and bolts and the nitty gritty flow of financial statements. So the income statement flowing into the balance sheet, flowing into the cash flow statement.
Yeah.
So I go back to my apartment, I'm building this model. I'm like, wow, this is actually really cool. And so I'm building this model. I'm like, hey, Professor Meissner, we're going to be running out of cash, about October, whatever it was. And he's like, okay, great. And then, he's like, so change this assumption and change that assumption. And then tell me, like, when do we run out of cash? So basically you get that internship outside of the normal classroom setting really set me up beautifully to build financial models, build these projections, and work in an M&A kind of environment where we're working with high caliber private equity firms and big lenders.
Yeah.
And just gave me that basis to say, this is how these deals are going to flow. And based on these assumptions, these are going to be the projections and the returns and all that. Yeah. And so I still use those skills today,
when underwriting deals.
Going on 30 years later. So that was super, super valuable. And so when I got out of business school and I went out in the marketplace, I wanted to do deals. It was just, I don't know, I just kind of liked the idea of doing transactions. And so when I interviewed with this company, they had just been a management team had just come in and acquired this sleepy government contracting firm. But the CEO is like this 40-year-old dude, Harvard MBA, Harvard undergrad, first Boston investment banking. He surrounded himself with some pretty amazing people. And they bought this company and they were going to use it as a platform to then grow and
Sure.
reposition the company. Because back then it was the very beginning of the internet, very beginning of all this new technology push. And it was a government contractor, so a lot of those really cutting edge technologies came
Yeah.
out of the government and government funded
Sure.
research organizations like DARPA and that sort of thing. So anyway, what an amazing environment to come out of business school and just go in as a young person to like learn all this cool stuff and being surrounded by ex-fighter pilots,
Wow.
astronauts. Like,
Wow.
I mean, just really, it was
Wow.
really amazing. And so it gave me that really solid foundation to, continue building on my finance career. But I always had this kind of burning desire, Matt, to go do something on my own. So, we can jump into that if you want. I can pause, but that was really kind of the beginning of where of the skill set that I am still, building on to this day.
So tell me about your most either the most exciting, the most profitable, or just the most
It's
fun acquisition that
it's
you did, and
uh,
then we can talk through underwriting and how it cascades into your current.
yeah, you're testing my memory here, so I'm sure I'll get the numbers wrong, but you'll get the idea. So this company, like I said, this aerospace company was really the platform for building it
Yeah.
into really a cutting edge internet and asset management kind of company. And so we were growing aggressively through acquisition. And we picked up like a $20 million acquisition here and
Wow.
a $50 million acquisition there. Well, at this one point, we had three deals that were closing on the same day. So in one day, we acquired $120 million company, and then like a $20 million company, and then like a $50 million. So we had hundreds of millions of dollars transacting that day and conveying from here to there. And at the same time, we were recapitalizing the company. So we brought in this new private equity company. We brought in this whole new debt facility that was multi-layered, right? So we had like a revolving piece, and then we
Wow.
had like a term piece, and it was actually really crazy. Here's we keep these tombstones. When you
Yeah.
do
Yeah.
deals out in the
Yeah.
world, you get what's called a tombstone. So this is a part of the
That's
tombstone from
awesome.
that day. So this says Viridian
140 million.
Corporation, $140 million revolving credit and term loan facility. So it was quite an amazing day. And
How young were you when you got that tombstone?
yeah, so I was I guess I must have been 20, I must have been about 30.
Wow.
I was about 30, and I'm working like with these Wall Street, private equity firms and these big, banking institutions. And I was, doing all the modeling, and I was in charge too of like the sources and uses, right? So we've got all, we're buying these companies, and we've got these fees for these attorneys and these fees for these other attorneys and all these closing costs, and this much goes to that company, et cetera. And then and then the sources, right? That's where the private equity coming in and taking out this other private equity and
Yeah.
layering in all this debt. And I mean,
Yeah.
it was nuts. It was
Wow.
it was really nuts. But that was very exciting. And what ended up happening was the management team I mentioned bought the company, the Sleepy Research
Yeah.
and Development Company. I think they paid about 5 times earnings for
Hmm.
that company.
Hmm.
And then less than 10 years later, they sold it to General Dynamics
Wow.
for 15 times
Wow.
earnings.
Which had grown significantly with
Because
all
it
those
had grown
acquisitions.
significantly,
Wow.
it had grown and repositioned. So it was kind of a sleepy research, development, test, and evaluation company, an RDT&E company they call it.
Yeah. Yeah.
And through these acquisitions, we were able to reposition it into this higher multiple, higher value kind of sector. and able to sell it to General Dynamics for, for a huge number. So
what drives that? So company does $1 million, you pay 5 times earnings and it's $5 million. What allows you to charge 15 or to sell? What allows the buyer to see value at 15 times earnings? What is the repositioning that happens?
Yeah, so it's because of the new capabilities that the company basically acquired and developed during that time. So, at the lower level, it's not that exciting, it's not that profitable. There's not a lot of growth potential, so you get paid this multiple. But if you're able to, bring in or acquire or develop or otherwise get these cutting edge technologies in these high growth areas that are high margin with, amazing future potential, then you're going to reposition from a 5X company to a 15X company.
Right. So let's switch now. You're super involved in the acquisition of self-storage deals with a couple of different niches that I want to touch on. But how do you take those principles from your days in M&A and understand whether you should be paying 5 times earnings equivalent? I mean, now we're talking NOI and some different terms, or 15.
Yeah, it's such a great question because it really does transfer over because at Belrose Storage Group, we're acquiring what we call value add self-storage facilities. So what does value add means? Well, it means there's an asset that's underperforming, right? So there's meat on the bone, there's value left on the table. And a lot of times it's because it's a mom and pop owned facility. They're not cutting edge operators. They're not implementing the latest technologies. They're not going to the conferences and the seminars and the mastermind groups to learn about best practices in self-storage. They just have this business that they have owned for whatever, 20 years, and they know all their customers and the units are full, so they're happy and they like the amount of money that's coming in each month. So they live their lives and go to the beach or play golf or whatever, and that's fine and that's wonderful. But when we come along, we see that there's value to be added to this facility by implementing the latest technologies, by cutting expenses, by using technology, by pushing rates, because a lot of these moms and pops, they're kind of asleep at the wheel.
They're just happy with occupancy.
It's fine. Exactly. Their key performance indicator, their KPI is, are we full?
Yeah.
Hey, if we're full, we're good. But that's not how you run a self-storage facilities the best way. It's kind of like in the hotel and the airline industry, right? If a hotel is full, they know they're not charging enough. I have a buddy of mine used to be in the hotel business. He said, if we're over 90% full, we're not charging enough.
Right.
And the same with the airlines. You have a fixed cost to fly that plane, right? So you've got to fill those seats, but you also have to play the supply and demand game, right? So we've all logged in, looked at flights, and then you go to book it a few days later and the price is higher, like,
yeah, for sure.
But that's what they're doing. And so that's what we do through our sophisticated technology and management platforms is we are able to do what's called dynamic pricing. We're able to scan the competitors and see, like, in more or less real time, like, how should we be charging for a 10 by 10 as compared to what's going on in the market. And then similarly, we do what's called premium pricing. So units that are more conveniently located, like if they're sort of the front of the facility, near the entrance, we can charge a higher price for that because of the convenience factor, as opposed to having to drive back to the back of the facility. We charge less for that. So these are just a couple of examples of the kinds of things that Belrose Storage Group does to take a sleepy, 5X kind of asset
and turn it into 15
and reposition it into a more valuable asset and generate great returns for our investors.
How many markets are you in with self-storage?
So we're across 8 states. Okay. So, and even within the states where we have multiple, we're in different markets in those states. So it's one of the big things we look at, Matt, when we're looking at an acquisition, for sure.
Recognizing that not all 8 states are going to have the same macroeconomic characteristics. What are you seeing in terms of your ability to push rates on self-storage? Is it the same as it was in 2022? Is it lower? How are your occupancy rates? Like, what are you seeing trend-wise that could help some of our listeners understand what's going on in the economy today, because the Fed, fine, recently, and we're filming this at the first week of August or the second week of August 8th, but ultimately the jobs numbers came in lower than expected. We had a small correction in the stock market, but the numbers have been telling us for a while that we're kind of okay with the soft landing, where inflation is coming down. But it seems to me from, we manage 2,700 houses. We have a lot of data from rentals, what our tenants are able to pay. It seems like the average person is really hurting. And it seems to me also that self-storage is a good barometer because it tracks movement, who's moving from house to house, who needs more space but can't afford it, et cetera. A bunch of metrics. What are you seeing in the market in terms of the economy?
Yeah, you're spot on. We for a while there, we had those COVID winds at our backs, right?
Yeah.
And self-storage was in huge demand, right? Because people were having to take their spare bedroom and turn it into a home office.
Sure.
And there were still a lot of transactions going on with homes because that's a big driver of self-storage demand. And because interest rates were still low, et cetera. So, we had a few years there where things were really rocking and rolling nicely. We're back to reality now, though,
Yeah.
because the COVID winds are gone. We're back to kind of the seasonality of self-storage, and of course, we've had a huge run up in interest rates. People, which cut off the residential real estate transactions, right?
Sure.
Because people didn't want to, sell their 3% mortgage house and buy their 8% mortgage house, right? So that put the brakes on the real estate market. So self-storage across the country definitely felt the impact of that.
Yeah.
And so last year, our occupancies were down, our rates were down for sure across the portfolio and everyone's portfolio across the country. And so, we had to manage our way through that. And that's a couple of things came out of that. Number one is, man, were we glad that we were very conservative
Sure.
underwriters of
Sure.
deals, and that we're very selective. Like I
Sure.
mentioned, we're acquiring, a handful of facilities for every few hundred that we look at. So we make sure that we, protect our investors' capital by being conservative and good stewards. And that's also driven us, Matt, into a couple of niches, which I'll get more into later. But we are, like were just saying, we are definitely seeing our consumers are not absorbing rate increases.
Yeah.
It's starting to come back.
Yeah.
And it is market to market. So we have some markets that are a little more depressed. We have other markets where, they're still pretty robust. So this is, again, where our active and very sophisticated management team can go in and do that analysis and make sure we're running the property the most efficient way.
Yeah. Do you guys manage your own assets, or do you use third-party management?
We do. We manage our own assets. We have a internal operations team that oversees all of our facilities. Each facility has a human assigned to it, but that same human might be assigned to 3 or 4 or 5 facilities because, again, I've said it a million times so far, but we really leverage technology to help us manage our facilities more efficiently. So instead of having one, let's face it, anyone out there runs a business knows your personnel expense is one of your biggest expenses, right?
Yeah.
So we're able to take, the old model was you had one manager at one facility, and that manager's expensive. Well, with using technology, we're able to have that same manager manage 3, 4, 5, 6 facilities, and a lot of it can be done, right from their smartphone.
Yeah, yeah, interesting. I want to ask one question that kind of goes back a little bit.
Mm-hmm.
Mama Betty was managing her self-storage for the last 20 years.
Mm-hmm.
What has changed in the industry that brought in more sophisticated operators? Was there not the equivalent of you 20 years ago when Mama Betty happened into this potential good deal and just did it herself and was a self-operator for so long? Like what's changed?
He kind of freaked me out there because my mom's name is Betty. I was like, wait,
sorry.
I was like, what? He's researching like my family. Wow,
Mama Sarah.
He does a good job preparing for these interviews. But no, so yeah, no, my mom's awesome and she's a smart entrepreneur. So she probably would have, however many years ago, if she had seen the opportunity, she would have jumped at self-storage. But back then in, what we'll call kind of the first generation of self-storage in the 60s and 70s, you couldn't get financing, and it
Yeah.
was just kind of a rusty, dusty, little parcel in the back of a industrial area. And, some smart people were like, hey, people need to store their stuff. And
Yeah.
so they build it with their own money, their own equity, their own cash. And then as they started proving out the concept and growing it out, and then along, in the 80s and 90s come along, the big REITs, public storage, extra space, et cetera, they start to
Yeah.
develop. Now Wall Street's starting to take notice because they're like, wow, look at the numbers coming out of these self-storage properties in these up and down,
Sure.
economies. It's like, wow, this is a cash flowing business sitting on real estate. You get the tax benefits, but it's a highly leverageable model. So that's what got Wall Street's attention initially. Well, I wouldn't even say Wall Street initially. Initially, it was the banks that said, "Hey, you know what? This actually is a legitimate asset class." And they started lending, and that started the building, and that started the expansion
Got it.
of the self-storage industry. And then during COVID, that's when Wall Street really started to take notice. And so there's been tons of money raised in these private equity funds, looking to acquire self-storage. And now it's starting to spread internationally. A friend of mine, our mastermind group, he's looking at stuff in Dubai,
Wow.
over in the UK. So but I think it's, at least right now, it's more of a unique American problem. Like, we love buying stuff. We
And
love
we don't like
buying
to
too
throw it
much
away.
stuff. Yeah, we hate throwing it away, right? It's like, oh, my kids are gonna want that, that old oak, bedroom set. I'm gonna hold on. It's like, I just went, speaking of my mom, we just went through this with her recently because she moved from Pennsylvania down to Florida, and she moved out of a big house into a smaller house. She's like trying to give me stuff like, oh, this was a wedding gift for, I'm like, Mom, I love you, but I don't want that.
Right.
My
Right.
brother and
Right.
sister were all like, we're all grown adults. We don't want that stuff, right?
Yeah. Yeah.
So, but for whatever it is, Americans, we love holding on to our stuff, and we hate getting rid of it. And so we'll pay hundreds, if not
Crazy.
thousands and thousands of dollars to store hundreds of dollars worth of stuff that nobody wants. It's crazy.
Yeah. And fairly demand inelastic, because you raise prices $10 or $15, and the hassle of getting a truck to go down to the storage unit, find the key wherever that is for a lock that you haven't seen in 2 years. It's like days. But
Spot on.
What's
Spot
interesting
on.
is that banks didn't initially view this as a bankable, as a lendable product. Did they not understand what they were collateralizing? Like, why would they not have seen that opportunity?
They thought their argument was, well, okay, that's great. You have these units rented out, and the cash is coming in, but we could make this loan to you, and on day one, all your customers could move out, and now you have no cash flow. It's like, all right, really? Is that really, how realistic is that?
Yeah.
And so one of the things we've been tracking, and one of the things we talk to our investors about, is the adoption of self-storage. So the market penetration, to use the fancy term for it, right? So, a few years back, it was about 8% of households in the country were using storage. Now it's inching up closer to 12%. I know that might not sound like a lot, but
No,
when
it's
you consider
how
there's
many markets, how many households?
120 million households across the
Yeah.
country, every 1% move is 1.2 million new self-storage customers, and they're just not being built fast enough. Municipalities do not like self-storage. They're not approving these self-storage projects because they're not super sexy. There's not a lot of employees there, so it doesn't generate a lot of tax income for the municipality. And so these municipalities kind of want like maybe a sexier asset to go in there. But meanwhile, the demand is growing and growing. But the facilities are just not keeping up. And you're seeing that in housing too, right?
Sure.
Matt? I mean, it's like we have this growth going on, but the can't build the houses fast enough, can't build the apartments fast enough, can't build the self-storage facilities fast enough, can't build the boat and RV facilities fast enough, can't build the pro storage fast enough. So it's all of these factors are just lagging, and it's so we're happy to play that supply demand imbalance game and make great
Sure.
returns for our
I mean,
investors.
we see this. I sit on the planning commission here in town, and we see it all the time where a developer wants to come
Mhm.
in and satisfy the demand by
Mhm.
adding additional supply, and there's a huge NIMBYism
Mhm.
problem. Nobody
Yep.
wants, I'm sure, self-storage, but people also don't
Yep.
want in an established single family third of an acre to half an acre lot neighborhood. Nobody wants
Mhm.
quarter acre lots, and they all come in and fight it. It's like, well, we're in a really tough position here. I own a ton of real estate, so I'm
Mhm.
also happy to maintain the status quo and keep pushing up rent prices and housing prices. But ultimately, the city needs more self-storage, it
Mhm.
needs more housing, and it has to go somewhere. And nobody wants it in
Yeah,
their backyard, but
that's
ultimately it
right.
has to go somewhere. But in your position where you own a lot of self-storage, it's also great when the municipality turns it down and
It's
prices can continue to climb.
it's a
Tough for
barrier
the
to
consumer.
entry.
Yeah.
Yeah, it's a barrier to entry, but yeah.
Let's
Yeah,
talk for a second about the SAFE method for passive investing. I mean, what is the
sure.
SAFE method? How do you explain it to people? Why is it interesting?
Yeah, sure. So I've been a full-time investor since 2006, so over 18 years. And over the years, I made some good investments and I made some bad investments,
Sure.
right? So, even though I had this great background with the aerospace company and MBA and all that cool stuff, like, you can still make bad decisions. And so what I did is, my partner Joe Downs and I, we kind of compiled all of these stories together and we kind of boiled it down into a series of questions that investors need to be asking to make wise investment
Yeah.
decisions. So we came up with what we call the SAFE method, the safe investing method. Investing is not safe, but if you follow the SAFE method, you can at least de-risk your
Sure.
investment choices and hopefully make some good decisions. So it's SAFE is an acronym. It's S.A.F.E. S stands for sponsor. Matt, I cannot tell you, it drives me nuts how many investors skip over the sponsor and they just start looking at the deal. What are the returns? What's the asset class? Oh, I want to get into multifamily. Oh, I want to get into short-term rent. So they have to stop and start with the sponsor. Who's running this deal? I mean, you're going to be wiring your 50, 100, 250 grand somewhere. Who are you sending it to? What's their background? What's their team
Track
look
record.
like? What's their track record?
Yeah.
I mean, Google their names. You might be
How many
surprised what
SEC
you find.
investigations
Right. I
have they
mean,
been under?
exactly. Had I done that, Matt, geez, going back maybe 15 years ago, I invested with a guy because I liked him. I thought he was funny. And I liked his business model.
Yeah.
Well, it turns out he was just a scam artist and he
Wow.
ended up stealing 50,000 bucks from me. Had I Googled his name, I would have seen a ton of
Yeah.
SEC investigations and all this
Yeah.
other stuff. Now, in my own defense, 15 years ago, Google was not what it is today. It was very early
Yeah.
kind of search engine, but even so, I had I just Googled his name, I would have saved myself 50 grand and a lot of heartache. So the Safe Method ebook, which is available on our website, belrosestoragegroup.com, gives you a list of questions to ask your sponsor. And I know some people are like, well, I don't know. I don't want to ask him about like what his net worth is or, if he's a criminal or can I do a background check? In my opinion, if you're handing, because I invest in as an LP too, I invest in other people's deals. And if I'm investing in someone else's deal, I feel like that gives me
Yeah. The
the
authority to ask
ability,
the
the
right. Yeah.
authority to ask those hard questions.
Yeah.
And it can be uncomfortable, especially if you've known this person for a while, like socially or whatever. But it's like, hey, this is business. This is real money
Is there a net worth threshold that you would say makes sense or doesn't make sense? I mean, I would think that
for
the
the
number of
sponsor.
successful exits and a bunch of other questions, but net worth is a really interesting one that I've not considered. You definitely want to. There's a higher propensity for
Mhm.
somebody that's worth nothing to steal your money. I would kind of see that correlation. But
Totally.
what would you say is a reasonable net worth before you start handing somebody $50 or hundred
I
thousand
mean, I
dollars?
would want them to have a net worth, hopefully they're at least an accredited
Yeah,
investor, right?
that's
I mean,
bottom threshold. Yeah,
I would say that's the minimum.
yeah,
And which is $1 million, with not including your primary residence for those who don't know what an accredited investor is. So I would want that as an absolute floor, right? And then, and I also want to hear like, hey, what did you fail at? Because nobody's gotten here to
yeah.
like I've failed plenty of times. And I've learned and I've applied, what I've learned and, helped me to grow my business and grow our investor
Sure.
base because of that level of transparency. So anyway, so sponsor, it's huge, 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 huge plus to get to know your sponsor. A is for asset. What is it that you're investing in, right? So if you invest in a Belrose Storage Group deal, you're buying membership interests in an LLC that owns a property, right? If you can't explain what the asset is to your mom, if I can't
Yeah.
explain it to Betty
Yeah.
or explain it to my, 20-year-old kid, then, it might not be a good investment for you because you
It's
really need
like,
to understand.
can you pronounce the ingredient? That's the pronounce the
That's
ingredient
right. The
rule. Yeah.
pronouncing ingredient.
Yeah. Yeah.
That's right. Yeah. So people, and God bless them, people are investing in crypto. Like, good for you. I hope you make a bunch of money, but can you explain to me exactly what it is that you're investing in?
That's why I never
I,
have. And I feel foolish when it goes up
yeah.
to $70,000. I'm like, I just still can't. I can't. There's no way.
Well, yeah. Anyway, so you got to understand the asset. What's the market? Like we were talking about markets earlier. What market is that? If you're looking at a real estate deal, multifamily,
Yeah.
rentals, self storage, whatever. What's going on in that market? Is it like a one factory town? And if that factory goes out of business, the city, that town goes out of business. So you need to dig into the asset and what is it exactly? And then financials is, what are the financial projections? What are the tax implications? Has the sponsor hit these kind of financial projections in the past? Have they generated these kinds of returns?
Yeah.
And then in your own personal portfolio, how much of my own personal net worth am I putting into this investment? And how do I feel about that? Am I putting too many eggs in one basket kind of thing, right? And then lastly,
On the
yeah.
financials,
Mhm.
my question was around returns.
Mhm.
Oh, now I forgot it. I should have written it down. Returns, you were saying when you ask about returns. No, I forgot it.
Mhm.
Never mind. Go ahead. On the
All
E.
good. All good. So then E, right, is for exit. How do you get out of this thing, right? It's not like you can go to schwab.com and click,
Yeah.
click, click and sell your position in a short-term rental deal or in a self-storage deal or whatever. It just doesn't work that way.
Yeah.
So as an investor, you need to understand how long is my capital going to be tied up? What needs to happen for me to get my capital back? And who's in charge of that, and can I get out early if I need to, or what are the mechanisms for me to maybe push for an earlier exit, or you need to
Yeah.
understand like all of those things. So S.A.F.E, the safe investment method ebook is on our website. It's free, so pick that
Love
up.
that.
Hopefully it'll make what I'm hoping, Matt, actually is because it's pretty elementary, but it's also very important stuff that's in there. But what I'm hoping is that if there's an investor out there who, they're wanting to get into alternative investments, they've seen the volatility in the stock market, and they're like, you know what,
Recently.
I've had enough of that,
Yeah.
but they just don't know how to take that first step. I think the safe investing method is a great way to just get comfortable. Like, what
Yeah.
are those questions you need to be asking? Because not,
Yeah.
someone who's they're an engineer, they're a tech guy, or they're a sales guy, or they see the opportunity, but just not sure how to take that
Yeah.
step. And I think our ebook is a great map to just
Sure.
help them take that first step. And
Sure.
reach out to guys like you, reach out to guys like me. We're a small boutique organization, right? It's not. Speaking of Schwab, right? You can't call up Schwab and talk to Charles Schwab and say, "Hey, how's the market?" Go. But you can pick up the phone and call Matt. You can pick up the phone and call Tom, and we'll spend whatever time we want. You want to get your questions
Sure.
answered so that you're
Yeah.
comfortable. And if you don't like me, you don't like self-sort, great. There are so many
You'll
other
learn something
alternatives
for
out there.
sure.
You'll learn something for sure. And one of the things, one of the webinars we put out there before is how to build a predictable portfolio. And so we have a 4-step program to do that. I'm happy to go over that if anyone wants to set up a call.
Yeah. I remember my question. A lot of
Oh, good.
a lot of people may say, and you have mentioned before, conservative underwriting assumptions. How would an accredited but fairly unsophisticated, potentially fairly unsophisticated to self-storage investor understand whether underwriting assumptions are actually conservative?
That's a really good question. I would say I would look at two things if I had to really boil it down. I mean, look, anybody who's become an accredited investor, I would think they have some level of, maybe some business savvy or something like that. So my suggestion would be look at the revenue projections for the self-storage
They don't
facility
hockey
or the
stick.
right or the multifamily or
Yeah.
whatever. Yeah, if they're going up 20% a year, I mean, this isn't technology, right? I used to be in tech after I did my aerospace and all that stuff. I was in technology investment banking for a while. And I saw so many like crazy hockey stick projections. I was like, huh? Anyway, if the numbers just don't make sense, like if the revenue's increasing 20% a year, but you look in that market and the rental rate trend history has been,
Doesn't
rates
reflect
have
that.
only been going
Yeah.
up 5% a year.
Yeah.
How is that going to work?
Yeah.
So I would look simply at the revenue projections. And I mean, you can get more sophisticated and look at the other expenses, but I would start simply at the revenue. And then the other thing I would look at, and this might be a little in the weeds, but hopefully you guys will track with me here. Um, there's a terminal value when you're sorry to sound like a
Yeah.
finance
Yeah.
nerd,
No,
but
there's
that's what I am. I
a
can't
sale
help it.
value at some point,
Yeah, so there's that sale value in the future that we call the terminal value, right? And that terminal value is a huge factor in the return equation, right?
yeah.
So does that, if they're buying a facility this year for $3 million and they're saying we're going to sell it in 5 years for 15 million, I mean, does that
Right.
really pass the sniff test,
Yeah.
And so if you're seeing big projections like that, and specifically, there's something called a cap rate.
They're
If
buying it at a
they're
9 and selling it at 3.
Yeah, if you're buying at a
Okay.
9 cap and selling at a 3 cap, it's like, huh?
Yeah.
What we've done over the past couple of years, because I mean, it was no surprise that cap rates were going to be going up, right? Because cap rates typically track with inflation
Yeah.
and interest rates.
Yeah.
So a couple of years ago, I was telling my acquisitions team, like, guys, look, I know this is going to make it tough for us to compete on deals, but we have to adjust our exit valuation assumptions.
Yeah.
Because interest rates are going up, cap rates are going to go up, negative leverage deals. It's sorry to throw another
Yeah.
nerdy term,
No,
but
but it's happening.
it's just, maybe this, big but dumb money might come in and buy some of these facilities, overpay because the financials, just aren't there for like a traditional, syndicator like us. But we had to do it, and that's why we only acquire, maybe one out of 75 or 100 deals,
Yeah.
because it has to work, has to project. Because at the end of the day, we're here to help our investors build their wealth, and last thing we want to do is get them in a bad deal where
Sure.
they're going to end up upside down, and we're going to have a really difficult conversation. I'd rather be really discriminating up front and really disciplined up front. And then, and if things do go sideways, hey, maybe we only delivered a 10% return instead of a 20% return. But I think a lot of investors would be pretty happy
Yeah. Yeah.
with that low end of the range. So
Yeah. Let's end it with one final question. Let's talk for people that are interested in investing. Like, what were the numbers on the last deal that you underwrote, can recall, that would be indicative of a potential future deal that somebody might get involved in?
Yeah, sure. So we're not buying these huge monstrosity self-storage facilities, class A, like the big shiny glassy things you see public storage,
Sure.
in the middle of town. I mean, that's not us. We don't see a lot of we're not competitive in that space. We don't see a lot of value add that we can
Yep.
bring to that kind of deal. So the deals that we're buying are in kind of secondary and tertiary markets. So we're not in Baltimore, we're outside Baltimore. We're not in Atlanta, we're outside Atlanta,
Mhm.
right? So we find these facilities, and they're generally, call it in the $3 million range. We're typically on a deal like that, we're going to raise about $1.25 million or so
Wow.
from our investor base. Last thing we want to do is over leverage, right?
Yeah.
So like a year ago, we had a bank offering us 80% financing on a deal, and we said, you know what? No, thanks. We can see what's coming around the corner. Our numbers work for our investors really well at 75%.
Mhm.
So we're going to stick at 75. And we're glad we did because, of course, the market's softened and that facility, had we been at 80%, would be in real trouble. Now it's just sort of bumping along and we're getting ready to ramp it back up. So anyway, so on that particular deal, about half of the equity we raise in what we call our preferred equity tranche. So our preferred equity or a Class A is for a cash flow oriented investor. So this is an investor that is more interested in getting that monthly check than waiting for some big bounce on the back end. So our Class A, we typically pay between 8 and 9%. The checks are sent out monthly. When the deal sells, call it 3, 4, 5 years out, that investor will get their principal back, and then they get a small percentage off the top of the net profit. So it's geared to about a 10, 11, 12% overall return.
Okay.
And it's a priority situation. So they get paid first. So a lot of our investors came to us, a couple of years ago, and they were like, hey, I'm in retirement or getting toward retirement, and so we're listening to our investor base. We said, hey, let's create this cash flow tranche. Our Class B common shares, those are more traditional equity investments. So it's a 3, 4, 5 year hold. There might be a little bit of cash flow up front, but as the value add strategies kick in, that preferred payment made monthly can actually get up above the Class A preferred, but it might take some time. And then at the end, when we sell the facility, they get their capital back, and then we split profits with them. So our interests are very much aligned with our investors. If we perform well, they get paid and we get paid. So we like our interests to be as aligned as we can. Which honestly is why we do syndications and we don't have a fund, because this way our investors can look at our deals that come out and they say, hey, you know what? I don't really like that one for XYZ reason, but you know what? I like that one. So I'm going to participate in that one. In a fund, you're kind of handing your money over and then the sponsor is kind of making those go, no go decisions for you. And we don't think that necessarily lines up interests as well as a deal by deal syndication.
If you presented two deals to somebody and one had a 16% IRR and one had a 18%, what do you call it? Like a expected IRR. Why would somebody ever do the 16 if they had $50,000 to spend and they were going to put it in two $25,000 checks or write one $50,000 check? Why would they ever go with a lower IRR deal when there's a higher one on the table?
Yeah, that's such a good question. I would say, Matt, I've been building financial models going on 30 years, and I can tell you one thing.
They're never going to be right.
They're never going to be right. They're never going to, I mean, as hard as it is for me to say, because I love my models, man. And I mean, now I have a team that does it, but, I put a lot of heart and soul into those make sure they're tight. But yeah, at the end of the day, how am I going to pick a number, 5 years out and have it be, So that's why, when we put a deal out, we actually put a range of returns. So we put like, hey, here's our low case scenario, here's our high case scenario. And so I think that helps investors, understand that, there's variability here. Yeah. We're not fortune tellers. And so if there's a 16% deal and 18% deal, I'd say, hey, do both of them, because that's real diversification. Large cap, mid cap, small cap, value, that's not diversification. They all have a one correlation when the market drops, right?
Yeah.
But if there's a facility out in Tulsa and there's a facility in Atlanta, if something bad happens at the Atlanta facility, it's not going to impact the Tulsa facility in most cases, right? Unless there's some big, national or global catastrophic event. So that to me is true diversification. That's capital preservation, but you still have the opportunity for growth, tax advantages, cash flow, all that good stuff. So that's what I would say about picking those, picking and choosing.
Is there anything that we should talk about that I didn't ask about? Anything that is a fascinating, novel thing coming down in the industry?
Yeah. Well, I would say, I hinted earlier about two cool niches within self-storage that we're really excited about here at Belrose Storage Group. I mean, look, we love traditional storage, the drive up, renting out 10 by 10s or 10 by 15s with the 8 foot roll up door, great business, solid business. But as we've gotten into the business here, we're starting to see these other niches evolve that we're really excited about. One is boat and RV storage. So just like any other kind of real estate, you've got your fancy stuff and you've got your less fancy stuff. So there are boat and RV facilities that are like fully enclosed and they've got
Wow.
all the
Yeah.
amenities and class A, and you can just go and hang out next to your RV if you want, and smoke a cigar or whatever. They've got dump stations, all that stuff. And then there's others that are just canopied. And then there's others like the one that we just acquired in Minnesota. It's literally a parking lot with a fence and a gate and lighting and security cameras, and that's pretty much it. So
Wow.
I mean, talk about, being able to go back to the SAFE method, right? So the asset, I mean, it's pretty easy to get your head around a parking lot, right? So we charge by the space per month, and we just find areas where there's a population of boats and RVs. So Minnesota, if anyone's ever been up there, tons of lakes, tons of camping, tons of
Yep.
fishing. It's one of the biggest consumer states for boats and RVs in the country. I think it's
Cool.
in the top 5. So, and the thing is, kind of like we talked about earlier, Matt, there's 400,000 RVs built every year, but
Wow.
there's only 20,000 new RV parking places built every year. And all these new subdivisions, all these new developments for housing that are under HOAs,
They don't
they
want
don't
your
want
RV there.
boats and
Yeah.
RVs
Yeah.
parked in their fancy new neighborhood, right? So what do you have to do? We have to find some place off your property to park these things. We have customers, Matt, that drive like an hour to
To
get
pick
to
up their
our
RV or boat. Wow.
RV lot because that's the closest one where there was availability.
Wow.
So it's just nuts. And like in traditional storage, you've got your public storage, extra space, Cube Smart. You got those big guys you've heard of, those REITs that own thousands and thousands of stores. In the boat and RV space, there is no big player. The biggest player in boat and RV owns about 5,000. No, they not even. No, they own about 50 stores.
Wow. Wow.
So it's like wide open. It is wide open. And the customer is a little bit different too, right? Like if somebody's keeping a bunch of crap in a 10 by 10, and they feel like stopping, payments, like, yeah, okay, whatever. I lose.
I'm not giving up my
They're
boat.
they're not giving up the boat. They're not giving up the RV, right? So the customer base is very different. The other cool thing is when they do take their RV out, well, guess what? They keep paying for the space because they don't want to lose it.
Yeah.
So they might go tool around out west in their RV for a month or 2 or 3, but they continue to pay for their spot so that they
Yeah.
don't lose it. And then, where are they going to go? So the boat and RV space is super exciting. The other one is what we call pro storage, otherwise known as contractor storage or larger format storage. So we ran into this niche by accident, which was amazing. I love when that happens.
Love when that happens.
We bought a facility about a year ago in Wilmington, North Carolina. It was only 96 units, but these were, instead of a 10 by 10 with an 8 foot roll up door, these were like 18 by 25 and larger units with a 14-foot roll up door and a 20-foot ceiling. So all of the customers at this facility, there were some boat and RV people there, about 20% of the units, but the rest, about 80%, were contractors. So these are, your electricians, your
Sure.
plumbers, your landscapers, your carpenters, your HVAC guys, that they need a place to more or less run their business out of. A lot of contractors got screwed during COVID when the supply chains kind of shut down and they're waiting for materials
Yeah.
and they're
Yeah.
getting yelled at by their,
Yeah.
the property owner.
customers, yeah.
Hey, where's my stuff? My project's way behind. I mean, that happened to us. We had a project that took a year longer than it should have because our materials were stuck in a cargo ship off of California for a couple months or whatever.
Yeah.
So these guys are now they're stockpiling their materials and their equipment in these kinds of units so that they don't have to go through that again. And speaking of the residential market slowdown, right? Instead of selling and moving, now they're fixing up their house. They're like, hey, you know what? I think we will do the kitchen. We will do the bathrooms. We're going to repaint. And so contractors, I don't know if you've tried to get a contractor to your house recently to
Let's talk about that.
but it's tough, man.
Yeah.
And so there's huge demand for that kind of thing. Problem is for these contractors, these flex spaces that are like 15,000, 30,000 square feet in these industrial areas, they're all getting gobbled up by the Amazons and the last mile distributors of the world, right? So those guys are jacking up the rental rates and squeezing out these smaller mom and pop contractors. Sure. And they don't have a place to run their business. So at this facility in North Carolina, we have been learning all this. A year ago, when we acquired the facility, we were charging $450 a month for that 18 by 25. Guess where we're at here a year later?
$700.
$900. We've doubled the rent on that unit in 1 year. Wow. And we wish we had more units because when one goes,
I wish I was involved in that deal.
Our investors in that one are going to make out real well. But again, it's an area where there's no big player in that space, and there's not a lot of them. So, our big challenge here at Belrose Storage Group is, now we're having to shift to kind of a development model because we need to go build these things because the demand is there, but the supply isn't. So then we run into a lot of the NIMBY issues that we talked about a little while ago. So we've got some challenges ahead of us in terms of those spaces, but we're super excited about both the boat and RV and also that pro storage niche.
I love it. Tom Dunkel brings over 28 years of real estate finance and investing experience to his position as Chief Investment Officer at Belrose Storage Group and Belrose's other associated businesses that we didn't talk about today, but are also super interesting. Tom makes it his mission to find great investment opportunities for his clients while helping them meet their wealth building goals. And he's got a whole team of people that work with him to do that. Since launching a full-time career as a real estate investor in 2006, Tom has raised over $65 million in private money across 3 asset classes: self-storage, which we talked about, short-term rentals, which we didn't, and distressed mortgage debt, which we also didn't, but would make other interesting podcasts. Prior to investing in real estate, he worked in mergers and acquisitions, closing over $1.2 billion of deals in aerospace, IT services, software, and logistics, which was, I thought, a great part of this show. Tom lives in Wayne, Pennsylvania, enjoys golfing, hiking, and playing guitar, but we didn't get him to play for us today. We're going to do it on the next show for sure. As an avid investor and lifelong learner, Tom's actively involved in organizations, including Self-Storage Mastermind, is a Raise Masters coach, and was recently named a Marquee Who's Who honored listee. Tom, we appreciate you being on the show. One more time, how do people reach you if they want to reach out directly and have some of the conversations, deeper versions of the conversations we had today?
Matt, this is awesome, buddy. You asked some great questions. I hope everyone got a lot out of our chat today. But I'm Tom Dunkel. I'm Chief Investment Officer here at Belrose Storage Group. Just encourage folks to head to our website, belrosestorategroup.com. And you can get in touch with me there and also find our ebook on the safe investing method.
That's awesome. Thank you, Tom. Appreciate you.
Thanks for listening to the Same Day Podcast. Tune in to a new show each week and be sure to subscribe to get future episodes.